Thank you for joining in. I'll request for your patience for another 5 minutes. We'll wait for further participants to join in and we'll be starting by 12:05. Thank you for the participants for joining in. We'll shortly be starting in the next one odd minute. We're waiting for any further participants to be joining us. Good afternoon, everyone. On behalf of Ingenetus, I welcome all of you to Market Outlook. Prashasti, if you could please just confirm to me whether my screen is visible and I'm audible. You could type yes in the chat box, and that'll be great, and I can begin. Hi, if anybody could just confirm to me whether I am audible and visible, and you can type, yeah, you can type chat box in the chat box, yes, and we can begin. I am not getting any responses. All right. Thank you. So I welcome all of you to the Market Outlook session. We are meeting after a very long time. Thank you very much for connecting with us today. I would like to tell you that we've been keeping busy with some very exciting things, and one of them is that our sister concern, which is Provith Consultants, has just been licensed by SEBI as a registered investment advisor. This entitles us to not just distribute mutual fund products, but also to construct financial plans and work with you on investment advisory across various financial products. So, without much ado, let me introduce you to today's agenda. First of all, we will be talking about the global economy. We will be talking about what's happening across US, across India. We will be talking about the grand question. Equity markets have rallied to 67,000. Why has that happened? What next? What should investors be doing at this point of time? I'll be talking about the debt market outlook. I'll address various questions that investors often ask me. I'll talk to you about what various investors think at this point of time, whether they should be investing or not, where should they be investing, and what you should be doing as an investor. So, without much ado, let's get started. Abhishek, over to you. If you could present your screen and talk about what is happening in the global economy.
Hi, Shalini. Hi, everyone. Thanks for joining in today on a Saturday morning, and I'm glad that people have joined in to understand what's happening around the world and what's happening in the world of investments. Uh, so let's start off today and understand uh, the global economy first of all. What are we expecting in the global economy? What are the challenges, if any? And what are the opportunities? So I'll just quickly present my screen. This is the latest IMF growth forecast, which just came in uh, a few days back. Yeah, I hope my screen is visible. Shalini, is it visible? Shalini, I can't hear you if you're speaking anything. Yeah. So let's look at the economic outlook, the growth projections. This is very recently in July 23. So this is published by the IMF. So if you look at it, they have revised their projections for a lot of countries, India being one of them. So India in the last IMF was projected to grow at about 5.9. They have revised it to 6.1, and so is the US, right? So US is at about 1.8, the expectation, the growth projections for 2023. Now we'll talk about only a few major economies out of this. So we'll talk about US, we'll talk about Germany very in a very short statements, and we'll talk about China, right? Because these are the economies which generally have an overall impact into the markets as well. So let's talk about US. The US in 2023 is expected to grow at 1.8%. So what that clearly means is that there's no negative degrowth in United States. So the recession fear is is no longer there according to this projection. There is a slowdown for sure at 1.8%, but there is not a negative uh, growth or a degrowth in the United States. So that gives the Fed a lot of comfort, and hence you would have seen a few days back that Fed increased the rates by 0.25% again to 5.25 to 5.5%. So that gives them more comfort to battle inflation. The inflation numbers in the United States have come out to be good. The CPI has come out to be about 3%, but the core inflation is still sticky, which is bothering the Fed, and hence the rate hike which happened in just a few days back, right? So United States, I mean, looks to be all right. It doesn't look to be in any kind of a recessionary pressure at the moment, according to this report. Germany, on the other hand, does look at if you look at Germany at about minus 0.3%. Now there are various factors for that: inflation, rising interest rates, then the crude oil and the gas conflict with Russia, due to which Germany is expected to go under recession. But I think Germany as a country does not have a very overwhelming impact on the Indian markets per se. Uh, so you know, Germany is negative, and let's talk about China as well. So China is also, if you look at the growth rate for China at 5.2, and then in 2024 at 4.5. Uh, this is actually a slowdown for China, right? China is expected to grow at above 6%, but according to the IMF, it's expected to grow at 5.2 and 4.5. So that's a slowdown in China, and that is why in China, what you're seeing right now, where everywhere globally there are interest rate hikes which are happening, in China we just had a rate cut very recently because they want to boost this up, right? China's slowdown can be attributed to a lot of factors. One is the real estate problem in China. Now, real estate is a problem, for the overall economy. It's not a sectoral thing. So when real estate became a problem in China, it led to a low, consumer confidence, and then hence low demand internally in China. And of course, their exports are hampered because of all the major economies undergoing a slowdown. So that's why China is also kind of slowing down. Uh, so they are trying to reduce rates and boost up that growth rate. But I think if you look at the IMF report, so China is slowing down. So if I talk about this year, I think we're not expecting any rate cuts in the US or any of the European economies, but China has undergone a rate cut. We're expecting a rate cut in 2024 and then 2025 in United States, as well as probably in the European countries as well. And of course, Indian rate cuts will also start by, let's say, next year. Right, so this is an interesting chart which I wanted to show you. And just to highlight once again, India is expected to grow in 2024 at about 6.3. Of course, these are all projections. But the pace at which we grow in 2023 is going to continue, and in fact, better in 2024, right, at 6.3%. So that's what's happening in the world. I'll connect the dots to the Indian markets when I come to it. So let's come to the Indian markets per se. This is what has happened. This is data up till uh, July 2023. If you look at it till about, let's say, December, January, and in fact even February, this year, we've had a very huge outflow of the foreign investors, right? So FIIs, FDIs have all moved out, and we all know the reasons for this because of the rate hikes happening in the US. This flow was continuous, and we in total, or if we divide this in calendar year, we're talking about 1.21 lakh crores in 2022, But in 2023 till now, we've got a very good inflow, right? So if you look at 2023, it's about 1.07 lakh crores of inflow of foreign investors that we've got this year. What's changed? Why foreign investors have put in money into the Indian markets this year as compared to last year when they were pulling out? Interest rates were hiking last year as well, right? Indian macros were looking good last year as well. So what's changed this year is that one thing is that we are at a fag end. The Indian, if I talk about the macros for India, inflation is under control. The growth rate, as I just showed you in the previous chart, is exceptional, fastest in the world, fastest major economy in the world, um, and is expected to better in the coming years. Uh, Currency not fluctuating against the dollar, so a strong rupee, um, and that's also to do with crude oil. I think we've explained you or our investors many times when we meet them that crude declining or crude at a 70 or a below 70 dollar price is a sweet spot for India, right? Because India is a net importer. So if crude oil prices starts going up, it puts pressure on the Indian rupee, and Indian rupee kind of uh, you know uh, the dollar becomes more stronger and the rupee kind of depreciates because of that, right? So that's not good for the foreign investors. So foreign investors, along with the macros, also need a stable currency for them to generate returns out of a country. So till about February this year, if you noticed crude oil, I don't have the graph for it, but if you notice crude oil was around 80, 82, 83, right? 84. It was in that range. Once it started coming down, and from about, let's say, March, April onwards, when it started coming down to 75 and below, you if you see the screen, these are the inflows which is happening. So the foreign investors wanted to invest in India, because out of all the major economies, and if you go back to the previous chart that I just showed, out of all the major economies, China is slowing down. Eurozone doesn't look good. United Kingdom doesn't look good. China is slowing down. So the major economy which is doing well in terms of macros is India, right? So the Indian markets is backed by foreign inflows, but I want to show you one more graph before I hand over the stage to Shalini, which is this, a very interesting chart. Now, the title says it all: high price, high value. What that means is, so if you look at the trailing PE of the Sensex, right? The trailing PE, I'm just getting a little technical over here, but to explain you, PE is price to earning. So price to earning से हमें मार्केट्स हाउ चीप कितनी सस्ती है या कितनी महंगी है ये पता चलता है, राइट? इन अ नटशेल. सो न्यूमरेटर में प्राइस होता है. सो प्राइस इज द करंट सेंसेक्स लेवल्स, एंड नीचे अर्निंग्स होता है. सो प्राइस पर शेयर divided by earning per share. So earnings of all the companies which are listed at in the stock market, in the Sensex, in the BSE Sensex, right? So if you look at this figure, and it's a very interesting figure, let's see Jan 2022. Uh, right at the bottom, if you can see this, I'll just try to highlight it. Yeah. So if you see Jan 2022, we were at a 58,000 Sensex level, and we were sitting at a price to earning of 28. So just to give you a context for this particular factor, the higher the price to earning, the more expensive the market is, and the lower the price to earning, the cheaper the market is, right? So in January 2022, at a 58,000 level, 10,000, almost 8, 10,000 below the current levels, we were at a price to earning of almost 28, right? So which means that the markets were expensive at January 22 at a 58,000 level. Now, if we see July 23, and I've captured 66 6,700 over here. If we see July 23, the price to earning has actually come down to 24, right? So what that means is, so price जैसे मैंने अभी आपको बताया, price मतलब सेंसेक्स का जो वैल्यू, सो सेंसेक्स का वैल्यू तो एक्चुअली 58 से 66 गया है, तो न्यूमरेटर जो है एक्चुअली इंक्रीज हुआ है. आइडियली प्राइस टू अर्निंग यहाँ पे इंक्रीज होना चाहिए था, राइट? बट प्राइस टू अर्निंग इंक्रीज क्यों नहीं हुआ? क्योंकि अर्निंग्स विच इज द डिनोमिनेटर, द अर्निंग्स ऑफ द लिस्टेड कंपनीज एंड द कंपनीज लिस्टेड on the Sensex have also risen drastically. So we got good corporate earnings from all the companies. So what that means is जितने पेस से प्राइस ऊपर गया है, जितने पेस से सेंसेक्स ऊपर गया है, उससे कई ज्यादा पेस पे earnings of the companies ऊपर गई है, which is always very healthy for the stock markets, right? So हम जब ट्रेडिशनली जब हम स्टॉक मार्केट्स की बात करते हैं, एक स्टॉक मार्केट तब एक अच्छा रिटर्न देती है जब उनकी जो लिस्टेड कंपनीज है उनकी अर्निंग्स अच्छी हो, राइट? अर्निंग्स अच्छी होंगी तो ऑटोमेटिकली स्टॉक मार्केट के रिटर्न्स भी अच्छे होंगे. दैट्स वन फैक्टर. द सेकंड फैक्टर इज द एफआईआई फ्लो, right, which I just showed you in the previous graph. So what is expected and what are the risks? Of course, the Indian markets, always come, not just the Indian markets, the equity markets come with a risk, right? So let's talk about the factors which can impact the markets as well. Uh, yeah. So let's talk about the factors which can impact the market. What are the risks? Monsoons were a risk. There was an expectation that there can be a shortfall in the monsoons, which has not happened. We've actually had a good monsoon, so that risk is. I don't feel that's a risk any longer. Um, the state elections, the general elections next year, as of now, it doesn't look to be a big risk to the equity markets. So, what is the way forward for the equity markets, for the Indian markets? This year, we are getting good FII flows, crude being under control, currency being normal, all the macros looking good. The flows should continue. The earnings are very good of the Indian markets, as I just explained. The corporate earnings which are coming up are pretty good. The projection, the growth projections of the coming years by the IMF looks good. Next year, we are talking about rate cuts, not just in India. We are talking about rate cuts in the US as well. Whenever a rate cut happens, rate cuts are actually done to infuse liquidity into an economy. So whenever rate cuts happen, we're talking about more liquidity into the markets, into the economy, and then to the markets as well, right? So till about December 2024, I feel we are talking about a good period for the equity markets. But that being said, um, equity markets can correct due to any reason, which we don't know as of now, right? Something comes up after 3 months which we are not prepared of, and generally if you see that the equity markets correct because of reasons which are unknown. So if we talk about what should an investor do, that I think Shalini will tell you more about, that what should be done in the current markets. But if I talk about the overview of the global markets as well as India, I think we've covered more or less a lot of things. I hope I was able to, give you some inputs, some interesting facts about something which was interesting to all of you, and I hope I was able to, do that. Shalini, you want to take it forward from there, from here?
Thank you very much, Abhishek, for your views on the global markets as well as on the equity markets. Equity markets are indeed doing very well and are also expected to continue in the state of the global economy. Let me also speak to the investors on the debt market outlook. We have always maintained that equity, while capital appreciation is important for your future goals, capital protection is also equally important. So, certain points as far as the debt market is concerned, what are various investors doing in order to protect their money? Investors are using bank accounts in order to keep their funds at a 2.5% interest rate. Investors are keeping their money in fixed deposit, which is giving us what, 6% annualized returns. Investors are also using debt mutual funds, and the returns that we can expect out of debt mutual funds today are at about 8%. Please do remember that these are pre-taxation returns, pre-tax returns. The typical investor is going to be taxed at a 30% tax bracket, which means we are talking about 1.75% annualized return in a bank account post tax. In a fixed deposit, one can expect about a 5.6 or 4.2% annualized return. And debt funds are post taxation, giving us about 5.6% annualized return. So our view is that instead of keeping your hard-earned money in bank accounts, fixed deposit, or just pure debt funds, utilize hybrid funds such as asset allocator funds, provided you can hold this money for 3 years. Asset allocator funds can be very good examples of your emergency fund and funds that you need for specific goals in the next 1 to 3 years. And how does an asset allocator fund typically work? So you have an asset allocator fund putting in 25% of the capital in equity, and the remaining 75% goes into debt. So this 25% of equity continues to compound at 12% over the long term, and the remaining 75%, which is into debt, continues to compound at 8%. So together, these two instruments are able to offer you around 11.5 to 12% annualized return over the long term, ensuring that your capital remains protected. So investors should always look at hybrid funds in order to protect their capital. And we recommend that no matter how aggressive the investor is, if you have 100 rupees to invest, invest 90 rupees in equity, invest the remaining 10 in debt, and utilize this 10% which you are putting into debt or hybrid very, very strategically. So I'll just share my screen in order to tell people how this 10%, which is being maintained in a hybrid fund or debt fund, can be utilized in order to enhance the portfolio returns. Yes. So I hope my screen is visible to everybody. And I just wish to show you various events in the past where Sensex has corrected drastically, and how retaining about 10% into debt or hybrid ensures that you can utilize this strategically in order to enhance your portfolio returns. Now, think about March 2020 when Sensex had corrected due to COVID being declared a pandemic. You can see that Sensex was initially at 41,000 level. It corrected by 37% to 25,981. And those people who had the cash in form of hybrid funds or in form of debt funds or in the form of any liquidity which was being maintained with them, these investors, if they had courage to invest into the equity markets during these steep market corrections, were able to get beautiful returns over the next 1 year. So you can see people who invested into the equity markets at this point of time, when Sensex had corrected by 37%, were immediately rewarded with 100% returns in just less than 1 year. Similar scenario played out in the 2008 global financial crisis, when investors put in their money during this market correction. Sensex had slid by 61% to 8,000. When investors could put in their money at this market corrections, they were rewarded with 150% returns in over 1 year. A very similar scenario was also there in 2015. Sensex had corrected by 22%, and this was when China, which was a very large economy even at that time, had devalued its currency. That event had sent global shockwaves across equity markets. So when Sensex corrected by another 22%, investors who could put in their money into the equity markets were rewarded with a 58% return in over 1 year. So this is the entire intent. These three C's, that is cash, courage, and crisis. These three events, when they come together, and investors, if they have the courage to put in their money into the equity markets at such market corrections, they are immediately rewarded for their patience as well as for their courage. So use the debt that you are holding in your portfolios to your advantage to in order to gain from such corrections. Next, I also wanted to talk to you that what are various investors thinking at this point of time. When I meet various investors in my meetings, what are these investors talking about? And I'm sure that these will be very, very pertinent questions for all of you as well. Uh, Last month itself, Sensex was at around 65,000. And I met an investor who had just had an increment in his salary at the beginning of the financial year and had also received a bonus. So his question was, Sharini, do you think I should be investing into equity markets at this point of time? Markets are already at a very, very high, and you don't know about markets. Markets could always correct. So the common question that I am faced is whether they should be investing into equity market at this point of time. A very similar scenario happened in 2019 when I joined Ingenetus. At that point of time as well, there was an investor who was asking me about the market conditions. At that time, Sensex was at 35,000. He was worried about investing into the equity markets. In fact, he chose not to because the markets were very, very high, and it was also volatile due to the liquidity crisis in 2019. If you remember, there were a lot of AAA rated companies, including DHFL, ILFS, that were defaulting at that point of time. So the investor did not invest. 1 year after that, in 2020, I met him. And the Sensex was at 41,000 at that point of time. He told me the markets have already gone up by 6,000. I wish I had invested at that point of time and I would have been rewarded. So, a very common analysis that can be drawn from these two situations is that every single high that Sensex will present to you will be a foundation for another high. And for this, let me just show you another graph. Again, I hope the screen is visible. So this is the journey of Sensex from 1980 to 2022. It has been marred by a lot of events, including COVID, the global financial crisis, etc. And it has also made a lot of highs. The last recent high was in 2021, just prior to Ukraine being invaded. So you can see this high over here, which was at around 61,000. Prior to that, there was the high just prior to COVID being declared a pandemic. Markets were at 41,000. A similar high in 2008, just before the global financial crisis. Markets were at 2,000. Prior to Harshad Mehta scam, somewhere over here, there was another high at 5,000. In spite of all of these highs, in spite of all of the corrections that are followed, markets have continued to go up. So if there's another analysis that I can draw out of this graph is चाहे इंसान हो या stock markets हो, दोनों ने आखिर ऊपर ही जाना है. So any high that the market presents to you is going to be a foundation for another high. And if you look at the returns of Sensex over the past 10 years, Sensex has given you a 12% annualized return. It will continue to give you this return, provided you have the patience of at least 3 years to invest into the equity market. Another very common question that investors tell me, so whether you have lump sum to invest at this point of time or you have SIPs to invest, please do utilize the markets to invest into at this point of time. If you have 100 rupees to invest, 90% should be going into the equity markets, 10% should be going into the hybrid markets, and use this 10% in order to shift into the equity markets whenever the markets are offering you a steep correction. At the same time, utilize small caps to invest. Small caps are the real wealth creators for you in the long term. I'll tell you why is it that I'm telling you about small caps. So a lot of investors tend to become scared of the word small caps. They feel that if they are investing into smaller companies, these smaller companies can vanish and their money will erode. Please note that the small cap sort of an analogy or the nomenclature is only given by SEBI. Small cap companies that are listed are not very small cap. We are looking at market capitalization of 10,000 crore, 15,000 crore companies as well. And these are nowhere small companies to invest in. So if you're looking at real wealth creation, in your portfolio, small caps are going to be the best wealth creators. Look at them for your long term goals, such as your retirement goals as well as your children education goals. In fact, I remember in 2019 I was having a discussion with the fund manager at Tata Mutual Fund. This person was Chandra Prakash Padiyar, and small caps were highly corrected at that point of time. So his statement was that, look, small caps are undervalued. So Abhishek just explained the concept of valuation. So small caps were highly corrected, they were undervalued, and they presented a good opportunity. These companies presented the opportunity to double in the next 5 years, and that's what Chandra Prakar Pariya had mentioned. He mentioned that if investors have the patience as well as the courage in order to invest into small caps, this money can be doubled in the next 5 years, and that story has effectively played out from 2018 to 2023. Any small cap fund, any good small cap fund, which is worth its toll, and just not just Tata, has been able to reward investors with 100% absolute returns over 5 years. So use them effectively to your advantage. So, second question that people do ask me is, where should we be investing? Uh, we've talked about asset allocation. So, if 90% goes into equity markets, 10% should be going into hybrid funds. We've talked about small caps. Small caps you should be using in order to give you capital appreciation over the next 5 years. Use it effectively for your long term goals. And I'm going to give you another reason as to why small caps at this point of time. Yeah. Have a look at the valuations which are available to us in terms of large cap. So, if large caps average valuation has been somewhere around 17, the large cap current valuations are at around 19. Have a look at the mid cap valuations. Mid cap valuations currently are somewhere around 16, and you can see the average valuation of mid caps are at 16. Currently, mid caps are valued somewhere around 22. It is actually the small caps which are presenting you the real opportunity to invest as well as to double money over the next 5 years, because they are still close to their mean valuation. So, small caps average valuation is somewhere around 14, and the current valuations are somewhere around 17. So, you can see that the opportunity at the moment is present in small caps such that they should be able to double their money across the next 5 years. All right, I'll just share my screen both once again. Sorry about that. So, due to some technical glitch, the screen was not visible. I hope the screen is visible. So, if you can just type in yes, that'll be great, and I'll be able to explain this once again. Is my screen visible to everyone? Thank you. Sorry about that technical glitch. So, once again, presenting the valuations to you. If you look at large cap companies, we're looking at HDFC Bank, ICICI Bank, Tata Motors. Typically, the large cap companies, the 100 top companies as per market capitalization. So, large cap average valuations are somewhere around 17, and this is where we are trading right now at an average valuation, a current valuation of 19 price to earnings. So, large caps are overvalued. Whenever you enter into the overvalued segment, naturally the upside that you would get will be restricted. Let's have a look at the mid cap valuations. So, mid caps are currently valued somewhere around 24, and you can see that the mean valuations were at around 17. So, a very, very overvalued segment. If you look at the small cap average valuations were at 14, and this is where we are trading right now, somewhere around 16. So, small cap is that segment which is undervalued at the moment. Naturally, when you're entering into an undervalued segment, the opportunity that you get in order to grow the portfolio is also very high. So small caps across all of the companies in the universe present a very good opportunity to you. Please ensure that you have an investment horizon of 5 years and you can be rewarded with 100% absolute returns. That means doubling your money. Use it effectively for your goals such as retirement goals as well as your children's education goal, provided that they are more than 5 years in time. Thirdly, another attractive segment that you should be looking at in terms of your portfolios is utilize global equities. So we've talked about how the global economy, US still seems to be in a recessionary state at the moment. So ensure holding 10% of global holding in your portfolio. Ensure holding good quality stocks such as Microsoft, Alphabet, Amazon, Tesla, Uber, Twitter. Very, very good quality technology companies in the US, very strong financial companies, and it doesn't look like that they will be having any competitors in the next 1 or 2 decades that could topple them. These are companies which are having good financial earnings, good quality corporate earnings, but at the same time, they are corrected at the moment. So, all of these technology companies have still not reached their all time high. If you look at a Tesla, it was commanding a very high valuation till 2021 December. It was at a price point of $303. Right now, we are still looking at a price point of 255. So, global good quality stocks are still undervalued at the moment. Hold 10% of these global stocks in your portfolio and don't just go about trying to buy global stocks. Give this advantage to the fund manager. Invest it through a global mutual fund which is available to you within India, where there is a fund manager who is deciding which global stocks to be buying and which global stocks to be selling for your advantage. So you don't have to put in your brain in trying to understand these global stocks. There is a fund manager who can do this job for you by investing into global mutual funds. Use global funds up to 10% in your portfolios in order to give you three distinct advantages. One advantage is INR depreciation. So in 1947, one US dollar was worth 3 rupees, and now we are sitting at 82 rupees for a dollar. So INR has effectively been depreciating against US dollar historically, and it will continue to do so because we are a net oil importer. Because we import crude oil and the world imports crude oil in US dollar. Hence, INR will continue to depreciate against US dollar always. So whenever you are investing in global funds, your currency is being converted into US dollar, and that means that whenever you take out the returns, you will get the net advantage of US dollar appreciation against INR. So typically, if a global stock is able to give you 15% annualized return, you will also get the 5% added advantage of the global INR depreciation, and that means your net return translates to a 20%. The second reason why you should be holding global mutual funds is that you also get geopolitical diversification. So right now we are in a scenario where Indian markets are doing very well. Tomorrow, if there is a correction in the Indian markets will also go down. They could go. We've seen that during COVID they've gone down as high as a 40%. So when due to certain scenarios, such as it could be due to a local war, a political war, a trade crisis, if Indian markets contract, that means that the 10% that you're holding in your global portfolios will continue to give you good returns at that point of time. At that point of time, if you want to withdraw for certain goals, your global portfolio is going to save you. Thirdly, we talked about how global stocks are available to at very very good attractive valuations. So due to these three reasons, you should be investing up to 10% of your portfolio into global stocks as well. So, with that, we've covered the global economy, we've talked about the equity market outlook, we've talked about what various investors ask us, and we talked about what investors should be doing in terms of their portfolios. So, that's going to be the end of our session. I'm going to leave it to the investors and the viewers to ask any questions. You can type in your questions in the chat box, and we'll attempt to answer as many. Okay, we do have some questions. So Prashasti is asked, is it wise to invest into mutual funds or individual stocks given the current Sensex record high? Prashasti, we did explain that whenever Sensex makes a new high, it is only a foundation for another high, provided you have an investment horizon for at least 3 years. Uh, do go into the equity markets. Even you, if you are investing into the equity markets at 67,000 level, equity markets are only going to make a further high from here. So you can safely invest into the equity markets through lump sums as well as through SIPs, provided your horizon is for 3 years. At the same time, look at asset allocation. Look at putting 90% into equities, 10% into hybrid funds. Use this 10% of hybrid funds smartly whenever there is a market correction. Use it to invest into equity and gain from that recovery. So, Mr. SK Sethi is asking us whether one should be investing into IPOs or not. One is not getting allotment due to heavy subscriptions for good IPOs. Suggest strategy. Mr. Sethi, we have seen previously that whenever a company goes for an IPO, it tends to have a heavily dressed balance sheet. It tends to have a heavily dressed valuation. Look at a lot of IPOs that have come in the past, including a Nika, a Zomato, Paytm. Very, very good companies. If you look at these business models, a Paytm is being heavily utilized by the entire country in order to do their transactions. Zomato is being utilized heavily by the entire country in order to order at any point of time. So good companies in terms of their business models, but when they go for their IPO listing, because prior to listing, SEBI directions are not very, very high. SEBI restrictions, SEBI governance on pre-listed companies, non-listed companies is not very high. A lot of companies can go for dressed up balance sheets. They can go for not fraudulent, but they can go for very, very high valuations, which the company is not necessarily demanding. We've seen this in the case of various IPOs, a lot of companies that I've just mentioned to you. So we feel that it is not very advisable. It is not a very prudent advice in order to, or a prudent decision in order to go for investments into IPOs. Rather, look at post listing. I understand that you may not get the same price that was available at the time of listing, but study these companies from a balance sheet perspective, study these companies from a valuation perspective. Are these companies indeed commanding the price which they should? Are these companies overvalued or undervalued? Look at buying these companies after understanding their financials as well as understanding their valuations. And then only after listing, look at buying these companies. Mr. Satpal asks us that in the recent past, it is observed that Sensex has scaled up quite high and the investors are delighted. But at the same time, some concern that what if the market crashes? So, Mr. Satpal, I just shown the graph of Sensex from 1980 till now. We have seen a lot of market crashes, right? In 1992, there was the Satyam, there was the Harshad Mehta scam. In 2018, there was the 2008, there was the global financial crisis. 2019, we looked at the AAA rated companies such as ILFS, DHFL not making their payments and defaulting. 2020, we saw the worst crash in the history of markets, which was a 40% steep correction. But after all of these corrections, see, these are events which are short lived. These tend to affect us investors because we are sentimental in nature. Because we are sentimental, we tend to withdraw from the markets, and that's why the markets correct. So these events tend to be short lived, and Sensex has a nature of going up. Markets have a nature of going up in the long term. So, in spite of all of these corrections in the almost 40-year history of Sensex and markets, markets have only gone up. Markets have, in fact, given a 12% constant annualized returns over the past 10 years in spite of all of these corrections. So, if you have a long term tenure in the market, if your goals are to stay invested and not to withdraw out of the market for the next 3 years, continue with the patience that you have shown, and you will continue to be rewarded with the market returns. So Mr. Santosh Kumar asks us why 5 years waiting for a long run. So typically, we have seen that the tenure that is required for large cap companies to perform well is 3 years. Within 3 years, you should be easily able to get returns from the large cap market, large cap stocks from the markets. When it comes to mid cap companies as well as small cap companies, they are more volatile because these are not very large companies. These can be easily affected by the inflows of both domestic institutional investors as well as foreign institutional investors. So, in order for the returns as well as the stock prices of small cap and mid cap companies to fully play out, you need a duration of 5 years. If you try to invest and come out of these stocks in before 5 years, you can see a lot of volatility. You may end up with capital erosion, and that is precisely why over 5 years small caps will easily be able to give you a good return, which we expect to be 100% absolute return. We have also observed in the past 10 years that there have been horizons for 5 years where small caps have not performed at all. So it is seeing that sort of experience and seeing the nature of these small cap companies, the fact that they are small and easily affected by inflows and outflows. We suggest investors to wait for at least 5 years for small cap and mid cap companies to fully play out their returns.
Also, just to add in to the point, Shalini, that why 5 years? So, Mr. Santosh, in actually 5 years, you complete uh, what we call as an investment cycle. Uh, so, an investment cycle can have 2 3 years of bear market, 2 3 years of bull market. So, 5 years, in 5 years, you are playing out the entire cycle, right? The bearish as well as the bullish cycle. So, your portfolio kind of matures in a patience level of more than 5 years. So, that's why 5 years for long run.
So most investors, most new investors into the markets have seen that these small cap companies have only been on a bull run. In fact, if somebody tells investors that it is not possible for small caps to correct or small caps to give negative returns, they will be surprised to note that from the period of almost 2018 till 2021, small caps did not perform at all. They were giving negative returns in the portfolios. People were very, very scared to get into small caps. So 3 years can be a little testing times for people who are invested in small caps, and that is why a 5 year period is a demonstrated period in which small caps have delivered returns over in the history. Mr. Vikas Goyal asks, please explain likely impact of de-dollarization on global ends. Mr. Vikas, I hope you are talking about the depreciation of INR currency. If that is indeed the correct understanding, uh, again, I'll just explain that INR has been constantly depreciating against dollar. So we started at 1 rupee, $1 was equivalent to 3 rupees in 1947. Today we are looking at a rupee value of 82 against a dollar. So constant depreciation of about 5% has been observed over the years, and this is because India is a net importer of crude oil. Since we are constantly importing crude oil in US dollar, our currency will continue to depreciate against dollar, and that means if you are investing in a global fund, your currency over here is INR in which you earn. This currency gets converted into dollar. when you are investing, and that means you are getting the added return of the dollar appreciation. So if the return of the fund is 15%, the INR depreciation factor is another 5%. These two add together to give you a net return of 20%.
So there's one more aspect to de-dollarization. I think Mr. Goel is also asking about a lot of countries actually promoting their own currency rather than a dollar, like India is trading with Russia in INR for crude oil. So, Mr. Goel, I think de-dollarization is still a long way to go because as you would have also read that although Russia is taking INR, uh, but it doesn't know what to do with the INR it has accumulated till now, right? Because INR is nowhere else accepted, right? And India doesn't have that much of resources in exports or in terms of manufacturing, which Russia can, buy from India and give that INR pool back. So till now, the de-dollarization is still a long way to go. It's a universally accepted currency, which will take a lot of time and effort by a lot of economies to do that. Uh, but if that happens, then obviously uh, if you take a hypothetical situation of, let's say, the dollar does go down in terms of acceptance and value, then global funds, I mean, as an economy, US will be still one of the five largest in the world. So I don't think there will be any problems in global funds per se. Um, but yeah, if dollar becomes weak and the rupee appreciates, then obviously that appreciation percentage adds as a negative return to the Indian investors, right? So if you're asking in that terms, uh, if a dollar, if the INR appreciates, then it adds as a negative return to the Indian investors' returns as compared to when it depreciates, right? So that's a little bit of impact which can be there.
Next question has been asked by Nikhil Mathur. Nikhil asks, many sector specific funds are coming up. Should you be investing into those? So you're right. Since 2020, we are seeing a lot of these sector specific funds to come. 2020, we saw the pharmaceutical and healthcare fund being launched by a lot of companies, naturally, because vaccinations were in demand, medicines were in demand post the pandemic. 2020, again, we saw a lot of companies come with IT funds because IT and digital was in demand because of work from home scenarios. The problem with these sectoral funds is the business cycle. So, Nikhil, if you look at a typical business cycle, it lasts for 10 years. You will see a good run for 5 years and a very bad run for the next 5 years. So, typical market cycle or a business cycle looks like this: 5 years of good performance, 5 years of a negative performance. The problem with these sectoral funds are that they are most likely going to be launched when the some of the stocks in it have already reached a high point of time. That means you are getting into an overvalued segment. Naturally, when you're getting into an overvalued sector, the upside becomes limited. Secondly, they are likely to give you some good performance for next 3 to 5 years, and the next 5 years are going to be very, very bad. Look at what happened to pharmaceuticals and healthcare companies post 21, 22, when these companies, pharmaceutical, vaccinations, medicines, stopped being in demand. So investors who had attractively got into the pharmaceutical fund in 2020 started seeing losses in their portfolio in 22 onwards. Similarly, people who went into IT, looking at the fact that IT is in huge demand in 21, started seeing losses because of all of the steep corrections which we're seeing in these stocks. Naturally, IT was in high demand in 21, but just as the IT was in demand, it stopped being in demand because offices once again reopened. People were going back to their offices, and those companies which had hired a lot of people for a reality which was no longer there had to retreat. They had to retrench all of these employees. They stopped seeing the same corporate earnings that they were used to, and IT went into a shock. Look at Infosys that has just corrected by 9% in the past few days. Just the problem with IT, from the problem with sector stocks or sectoral stocks is that one, of course, for they will be performing well for a high period. Then another, there is going to be a bad run as well. So you will not see a consistent performance in these sectoral stocks. Instead of them, we recommend getting into a lot of funds which offer you the flexibility to switch across sectors wherever the fund manager is seeing a good dynamics. So instead of pure sectoral funds, to getting into small cap funds, focused funds, large and mid cap funds, where the fund manager can change between sectors easily.
Also, to just highlight one more point in this, Nikhil, sectoral funds, the timing becomes very, very important for you, right? At what time you enter and what time you have to exit that particular sector, right? And getting the timing right is actually, a very easy thing to say on theory, but practically it becomes very difficult, right? uh, Once you've got the returns, if you've got the returns, whether you entered at the right time in that particular sector or you missed the rally. So it becomes very time specific whether when you have to get into that sector and when you have to get out of it. So rather, as Shalini said, it's better to have a diversified sector fund rather than a particular sector fund where you have to time it precisely. I think, Shalini, there is one more question of Achin about any recession seen in the Indian markets. So I'll, I'll take that question, Achin, and as I mentioned in the first 20 minutes and showed you the growth forecast, India is not expected to grow below 6%. So a recession is a scenario where a country is degrowing. So we're talking about negative growth. And as you saw in the projections by the IMF and the Indian internal projections as well, India is expected to grow by 6.1 and then by 6.3. So there doesn't seem to be any recessionary pressures in the Indian markets as of today when we're talking today. In the future, I mean, you can't talk about the longer future, but in the short future as well, we don't see any recession hitting the Indian markets. In fact, Indian markets are expected to grow the fastest in the world. So India will be the fastest major economy to grow in the coming few years, right? So we don't see any recession in the Indian markets. You want to add something, Shalini, to this?
That'll be all. Thank you very much, investors, for joining us today on the Market Outlook. We thank you for your patience as well as interest in the webinar. We will continue to see you in the next couple of market outlooks over the next few months. Take care. Thanks once again. Signing off. Bye bye.
Thank you, everybody. Take care. Bye bye.